All right, welcome everybody to today's presentation, Top 3 Tax Efficient Investment Strategies with Case Studies, with our special guest, Richard Wilson of the Family Office Club, who I'll introduce in just a moment. My name is William Mucker. I'm a client executive here with Camaplan. Before we get started, I have a brief disclosure to go over. This was just put together by some clever attorneys. I'm sure a lot of you have seen this already. This just lets you know that this presentation today is strictly for educational purposes. Camaplan is a neutral third-party administrator of self-directed IRAs. We do not sell anything. We do not endorse anybody. So that means we're not calling you, letting you know what the next shiny new investment is for your self-directed IRA. We just help facilitate the transactions when you come to us with the deal that you want to do. We always suggest that you do your due diligence whenever you're considering investing with somebody or hiring anybody for their services. And I'll leave my contact information here for anybody who has questions about the webinar and how it may apply to self-directed IRAs. You can reach me at the toll-free number here or one of these email addresses. And without further ado, I'll announce our presenter for today, Richard Wilson. Almost every investment can be made in a tax-efficient manner or not. In this presentation, Richard C. Wilson will share the top 3 tax-efficient investment strategies that his clients are using right now. This webinar will also include case studies of recent deals closed and investments being paper to close in Q1 of 2021. Starting in Q4 2020, Richard began his 100 tax expert interview series, and he has completed 37 of those 100 interviews to date. He will share some of the insights gained from that in this presentation. We will also draw insights on deal sourcing, negotiation, and private investor trends from closing on over $260 million of investment commitments over the last year. Attendees of today's webinar will get Richard's free books, How to Start a Family Office, The Single Family Office, and Centimillionaire Strategies, How to Turn the Top 6 Challenges of Ultra-Wealthy Families into Points of Strategic Advantage. Richard's information is listed here if you want to contact him with any of your questions. And without further ado, I'm going to mute myself and hand the keys over to Richard himself.
Great. Thank you very much. And thank you everybody for being here today. So I'm excited to be here because last year as Biden got elected, I started getting text messages and phone calls and emails even more often from my clients about taxation, tax strategies, questions about the tax code, what might be changing, but also just how to do a better job in managing their taxes. And I started our investor club in 2007. And since then, we have hosted 150 live events. I've recorded 2,300 videos like this one, or oftentimes shorter 10-minute videos on single topics. I've also authored 14 books, and I've met with over 3,000 ultra-wealthy investors face-to-face. Out of the 2,700 investors in our investor club, there's about 330 of them that work with me on a very close basis through investorclub.com. And we're constantly texting, calling, emailing, looking at investments, structuring investments. And so that's the perspective I come from for this talk today. And since I wrote the bio for this talk, we've completed more of our 100 tax expert interviews. So we have 52 of the 100 done so far, and we're offering the recordings of those for free. It's not a product we're selling. We're really doing it, honestly, selfishly, to become much more connected and intelligent on how to structure deals to be more tax efficient and how to manage my own taxes more efficiently. So we figured, while reaching out to 100 experts in the space, why not record those conversations and share them as a resource for free with investors who would want to, access those. So that's where a lot of the knowledge is coming from today. These are strategies that we have used or are using in deals right now. They go through a lot of things relatively quickly here since we just have about 30 more minutes, and I'd like to jump into questions, but I'd also like to have this be interactive. So it's not just me speaking and asking for questions at the end, but anytime you have a question about something I'm bringing up, we can stop and dig into it further or figure out how that could potentially apply to your area. I'm not a CPA. I am not a tax attorney. What I've done as a business owner is a lot of homework and research, interviewing a lot of CPAs and tax attorneys. And so I can help direct traffic to an expert. If you're interested in one of these strategies, I might say, oh, well, I know 3 people that do that. Why don't you speak to these 3 and just see who you would like? Just like Camaplan, I myself am not offering tax or tax consulting. That's not my business. I'm offering insights from a business owner who runs an investor club that I hope will be really helpful and practical to all of you. So today I'm going to talk about 3 different tax strategies that are top of mind and practical and easy to put into place and aren't super risky. Some people think that some things like conservation easements or really complex options and futures structured to avoid taxation are more on the risky end of the spectrum. So I like to focus on things that are more right down the road and not having you lose sleep at night, hopefully. Obviously, anything we say here, you should talk to an expert, make sure it's interpreted right for your situation, and all the details are looked into, because even talking about one strategy for 3 hours, it wouldn't go into every single detail or nuance about the area that you need to consider for different types of structures. One main theme to keep in mind is that every single investment you make for the rest of your life should be looked at through a tax planning lens. There is always a way to make an investment more tax efficient. And CamaPlan can help with that in terms of HSA accounts, covered L accounts, or self-directed IRAs, et cetera, and help with some of those options on making the investment more tax efficient. But even in your private accounts that are outside of retirement accounts, or these tax protected accounts that CamaPlan helps you get to a self-directed nature, there are ways to make your investments more tax efficient. So if you're not spending time thinking about that aspect of the deal, then you're really missing out. And it's not about not paying your fair share. It's not about trying to pay 0 taxes. It's about having your money work harder for you. If you are putting money to work in a tax efficient way, you might get 25% or 50% more return out of that investment than you would otherwise. And I'm going to give you several examples of that here today. So the first strategy is bonus depreciation. This is something that currently, as of the time of this recording, is allowed in the United States on investments where there is either equipment, it could be manufacturing equipment, it could be medical equipment, it could be installing dental chairs. Certain types of supplies might be depreciated, bonus depreciated, just like equipment. Also, if you are leasing a property instead of owning it and you have to build it out for a restaurant, for an urgent care center, for a car wash, et cetera, the building out of a leased property is typically also possible to bonus depreciate that. And what does that mean? It means that if you would normally depreciate the asset over 7, 10, 15, 20 years, meaning you buy a piece of equipment for $100,000, if you have to depreciate that over 10 years, it could be $10,000 of depreciation a year. A bonus depreciation allows you to buy that $100,000 piece of equipment and not depreciate it over its useful life and start depreciating that when it gets put into use, but instead you depreciate the whole thing at the time that it goes into use, which is bonus depreciation. And that means you're depreciating it all upfront. So when you invest that $100,000, it's a $100,000 write-off, essentially, typically for most businesses in the US. The difference here is that it makes it much more efficient and encourages capital expenditures, is what the government in part is trying to do, but it also can help with encouraging a CEO to use that to help them with raising capital and being more attractive to investors. So as an investor, if you're looking at any deal and they have equipment, they do tenant improvements on their locations, this would be something highly valuable to potentially put into use. So many examples of this that we're negotiating right now and have closed recently. One, and none of these are available as a pitch for investment. We have other investments that come up in the future, and we do have investments coming available every quarter, but none of these is an offering that you can email me and just put money in right now, and it's not a solicitation for these. These are just examples to make this super clear. So the first case was someone who was on my email list for the last 11 years. I didn't know that. They reached out about 14 months ago. We had a cup of coffee, exchanged more emails, had a Zoom call, met again in person. We took the next 11 months to structure a deal in their dental clinic chain, which is doing about $1.5 million a month right now. So probably do 17 million in revenue this year. And they're opening up 2 to 3, sometimes 4 locations a year. And they were opening up a new location at the end of last year. And so we structured a deal for investors that made it so that when they put in $100,000, because the dental clinic had tenant improvements on their dental clinic locations, we were able to provide a $100,000 tax benefit to the investor that can come in two forms. If you spend 750 plus hours a year on real estate, and that's 60% plus of what you do, you can probably be designated in the eyes of the IRS as a real estate professional. And that allows you to group your depreciation from different investments together. And it just gives you a better tax result at the end of the day. If you or your spouse, because if one of the two of you qualifies, you both then are treated the same. If you or your spouse don't qualify for that, then typically you would carry over that depreciation. And as cash flow comes off that investment, $100,000 worth of the income coming off that investment would be protected from taxation, because that would be passive income, and that's passive depreciation or passive loss. And those can be marked against each other over a period of typically 7 years. And so either way, it makes it very tax efficient. And what was interesting about this is that we work with a lot of dentists and anesthesiologists and surgeons and medical practice owners. And we went to a group of 65 dentists and doctors, and we said, hey, we have this dental deal coming up. I'd love to show it to 5 or 10 of your top clients who have sold their dental clinics or are making, $500,000 a year or more in dentistry. And they said, great, we'd like to take a look at it. But we showed it first to one of our healthcare industry clients that have put to work about $1.8 million the last year and a half with us on 5 different deals. We showed it to them first because they've been a loyal investor, very easy to work with. And we showed it to them and they said, oh, well, Richard, since you put a couple $100,000 of your money into that deal and there's only $300,000 left, we'll take the rest of the deal. And so they took the whole deal before we could even go to the group of dentists and doctors because it was so tax efficient. They said, we find tax efficient real estate deals, and they've done many of those deals. What they have a challenge with is finding tax efficient investments into operating businesses. And so I don't want to get into it on this call. We could always talk about it on another webinar about gross revenue royalties and how we turn investments into an income stream and get your money off the table faster as an investor. I think that's probably a separate webinar topic, but we did conclude that in this deal. And so it removes some of the illiquidity that investors typically are burdened by when they invest in a private company and then cross their fingers and hope in a decade they have an exit or start showing dividends to their investors. Many times they never get there. And that can be painful for a private investor to be illiquid for so long, not knowing if the company is going sideways, not getting clear communications, not getting any dividends out of the company. And so when they saw the deal, they responded the same day and said, we'll take the whole thing. We've spent a couple months with their due diligence and we had to tweak the legal agreements to be kosher for them. But the deal now is getting closed March 1st and everything's been agreed to in writing, et cetera. And that is the future of where our company is focusing a lot of time. And I would encourage you to focus a lot of time on making things like that more tax efficient. And so that was a dental clinic example. We also have an example in a retail business. It's a retail business that is related to car servicing, and they've done very well. They have sold a multi $10 million plus portfolio to a large investment bank of this exact same business model. Now they're in another state doing the same business model again. Before they had 23 locations and sold out for a great multiple. Now they're trying to build another 30 to 50 locations in this larger state with a higher population. And what they were doing is giving away 30% equity on every pod of 4 of these locations they opened at a time. They were giving away 30% of equity to investors. I told them, like, well, investors do want things that are tax efficient. So what if you gave away less equity, but made it much more tax efficient? And they are looking at that idea right now, and it brought them to the table as an ultra wealthy family to meet with us to potentially structure this deal. And the point of that is that it is, again, they're owning the real estate, but they're building out lots of equipment for this car servicing business. And if they're able to give more tax efficiency to someone than they were before, then the total return can be the same, even if they give them less of a return. So let's say the investor was getting a 7% a year return without the tax efficiency. Well, if you make it very tax efficient, then you can give the investor 5 or 6% return, but they're actually experiencing a 10% return because the money they put in was very tax efficient. An example of this is if you put $100,000 into a deal where you're able to protect that $100,000 from taxation, and you're in a state with 5% state taxes, then perhaps it's 40% total taxation when you combine federal and state. So if you put in $100,000, you're really only putting in $60,000 because of the tax efficiency, potentially. And so if you get just a 20% return on your money, you've doubled your money because you went from $60,000 to $120,000 on a $100,000 investment. From the company's perspective, they just gave you a 20% return. From your perspective, you doubled your money. That's where the power of this is really looking for this. There's many companies that you might want equity in, so to represent your interest best from an investor perspective. They might be just happy to get the deal closed. And let's say someone's raising $100,000, $300,000, et cetera. They might say, oh, well, you can have 20% of our company if you invest $300,000 because we're just doing $1 million in revenue or whatever it may be. And instead of designing it where they don't give you the equity, because you might want the equity and the tax benefits, they might just be so happy to find an investor that you could say, well, I'd like to have this little bit of collateral in place. And also, if they would agree to it, maybe a personal guarantee or some sort of real estate guarantee, et cetera, some sort of asset to assure your investment. A lot of people won't agree to that, but some might. But most importantly, I see that you are buying equipment. I see that you are building out tenant improvements on the property, that you're leasing, et cetera. Could we participate in the allotment of depreciation and the losses that would occur on paper for taxation purposes when we invest? And can we have the whole $300,000 be matched up against $300,000 in depreciation? Or what would the percentage be out of the $300,000? Would it just be $50,000 worth or $70,000 worth? But asking those right questions could unveil that they didn't even know they could use bonus depreciation, or it could get you an outsized percentage of the depreciation if it helps them raise the capital, and you could keep the 20% equity in the company and negotiate whatever else you normally negotiate. What I find is that a lot of private investors don't have a lot of deal flow. They don't see enough deals. They see 3 deals a year here, a couple from some events, one from their brother-in-law, a startup in their local community, a couple of real estate deals that are local. They keep an eye on LoopNet, but they don't see hundreds of deals or thousands of deals. Our team interacts with 45,000 professionals a year. We have 15 full-time professionals, and we have 6,000 a year that come to our live events. And so we're literally seeing thousands and thousands of deals. And what I'm seeing is that once you know these strategies, why would you ever do a deal that doesn't have a big use of these tax strategies? Because if out of 1,000 deals you see a year, or let's just make it more realistic, if you saw 50 deals a year, and you're usually seeing 5 or 10, but if you could grow that to 50, then your top 5 deals are going to be way better than if you only saw 5 deals a year. Everyone can agree with that very easily. Now, if you look at your top 5 deals, I would bet you that 3 of them have some sort of tax efficiency angle that dramatically changes the return. And as an investor, if you're having trouble getting a deal done and they don't want to give you the tax efficient structure, it seems like too much work, et cetera, you can always say, okay, well then how about I just get 15% of the company, not 20%, but you make this highly tax efficient for me and you protect me in this way. So you can use that as a point of leverage. Every CEO who values their company and legitimately thinks they have something real is going to lean forward when you tell them, well, if you do this, this, and this for me, I'm fine only getting 18% equity instead of 20. And the reality is you shouldn't even say that up front, because many just struggle with raising capital. They're happy to get the deal done. And if you make it tax efficient, you can bring in your brother-in-law, your friend, someone you work with, et cetera, and they might just take the whole deal with you and you make their life easy, and they give you better terms because you made their life easy. So that's the first strategy. I wanted to go deep into that and give several case studies, make it super practical. If anyone has questions, please submit them here, and I'll move on to the second strategy now. So the second one is that if you own real estate, you should do an engineering cost segregation study. This is when they look at the land underneath your property, they look at the structure on top of it, and then they analyze the amount of wiring, equipment, plumbing, space between the walls. There's a whole bunch of depreciation considerations, and they say, oh, okay, well, And on average, it's about 25 to 28% of the value of a property can be bonus depreciated using cost segregation. And they basically are looking at the property structure value versus the land value and coming up with an equation of bonus depreciating the value of that structure in a single year instead of over time. This is highly beneficial to real estate investors. It is common knowledge if you are investing consistently. This isn't some breakthrough miracle idea I've uncovered here. But what I found is that a lot of private investors do not know about this strategy. A lot of people who aren't running a real estate investment firm do not know about this. And there's several insights about this that I've gleaned over time. One is that if you own a personal home, especially an expensive one, but even a moderately priced one, as long as you have an affordable cost segregation group, I know of a great one that doesn't cost a lot, that does all of our cost seg group. I don't represent them. I don't get paid to promote them. But if anyone's stuck on that, it can definitely help you with that. But these groups typically will tell you that, and we've done a whole discussion panel on this with 5 cost seg experts, and they all agreed that if the land is worth less and there's more value in the structure as a percentage, there's going to be a higher percentage of depreciation write-off. What does that mean? In a practical sense, if you look at a property that cost $1 million, and let's say the land is worth $500,000 or slightly less, then if it typically comes out to a 28% of the value of the property, that means that you may get a $280,000 tax, bonus depreciation loss that first year when you invest. So if you buy $1 million property, you may or may not get this exact number, but you may get a $280,000, or more realistic might be, for this type of property, might be a $200,000 depreciation write-off. But real estate, almost everyone uses debt on real estate. We bought a multifamily deal last year and we just paid all cash and haven't put debt on it yet, but most people are doing, conservative investors, 50% debt, some 60, 65%. Most people aren't pushing it to 80% these days because banks are more slow to do that because of risk in the market and how unpredictable the world has been lately. But the point is that if you had $500,000 of debt on a property and $500,000 of equity to buy this $1 million property, and you get a $200,000 depreciation kind of loss to show that first year that you invest, then you would be only putting down the $500,000, but have $200,000 of a depreciation loss. If you're taxed at the 40% rate, well, half of $200,000 is $100,000, so a little bit less than that. So let's say $85,000 of a tax write-off or tax benefit that year. In other words, it might save you $85,000, and you put down the $500,000 and you saved $85,000. So it's almost like you only put down $415,000. This changes your IRR, and it changes the returns on the deal for you and investors coming into it. And if you had 75% debt and you only were putting down 25%, so you're only putting down $250,000, but it's $200,000 of depreciation write-off, you're actually protecting $200,000 worth of income from taxation. If that saves you $85,000, the numbers get a lot more interesting. Now, instead of you putting down $250,000 to acquire $1 million property, you effectively didn't put down $250,000. You only put down $175,000. And it's as if you put down $250,000. We could have a whole 4-hour half-day workshop on cost segregation. Many of you are already familiar with this. We're going to move on, but just know that this is best for when you own an asset for 5 to 7 years or longer. Oftentimes it makes sense, even if you don't know if you're going to own it for more than 2, 3, or 4 years, because you get the tax savings up front. Worst case, you have to give some of that back a little bit later. It also, many times people don't realize, if you have a home that has not improved in price, but is relatively expensive, $500,000, $1 million or more, it could be worth investigating that cost seg study on even a private home, not just commercial properties. If you own a big portfolio of single family homes, this could also be something to investigate. Okay, so I'm gonna go into number 3. The third strategy is actually a pair of 2 strategies in my mind. I think about typically at the same time. One is a HSA account, a health savings account. Typically, I mean, right now you can put in $7,200 this year, I believe, for if you have dependents or a spouse. And last year, I think in 2020, it was $7,100. But this can allow you to pay for, as long as you have a high deductible insurance plan, healthcare related expenses like prescriptions, or some of that money going towards the deductible amount, and have it be tax efficient. And you put it in there and it's protected from state and federal taxation, is my understanding. And also, you can then use it and put it to work for health expenses you would have paid with after tax money. But the smart thing to not miss on this, because many of you know that, is that you can track what health expenses you had every year, put money in here, it's protected from taxes, it can grow, protected from taxes, and document your health expenses every year. And just pay that potentially with your after-tax money is one strategy to consider. Now, 3 years, 5 years, 9 years from now, you've been putting in that $7,000 per year. That adds up over time into a good chunk of money. And let's say you decide 4 years from now, oh, you know what? I really need to take this money out and put it in something that's going to help my family, or something that I can't invest in through a self-directed, HSA account. At that point, you're allowed to go back and look at what those expenses were, have it documented, and then take that money out again without a tax penalty, because you did spend that money on these different healthcare costs and you kept the receipts or the transaction line items and what it was you bought and the dollar amount and the date, et cetera, maybe in an Excel spreadsheet or somewhere else with your accountant or CPA. That's really interesting, and that's different. And that can allow your money to compound and protect you from current taxation, which is always the most interesting ideas in my mind. And the other strategy related to this, but different, is 529 college fund plans. Many people know these because of state income tax protection around them. The money you put in, typically in the state that you invested into, have some sort of tax benefit, but that might only be $3,000 or $7,000 worth of contribution that's helping you at the state income tax level. This is after tax money that you're putting in at the federal level. It just helps you on the state level, I believe. But what's interesting and very unique about 529 plans is they really shouldn't be referred to as college saving plans. That's a big incentive for using them. But there are 38 different 529 plan variations across the United States, state by state, there's different ones. And in South Carolina, at least at the time of this recording, they have one of the top 3 or top 5 most favorable legal structures and state laws around this. So it's very hard or nearly impossible typically for someone to pierce that for lawsuits, for divorce, for other times where it could be at risk for judgments against you. So it gets out of your estate effectively, and you have to name someone as the beneficiary, and it can pay for their continuing education later. But you're also at times able to use this for long-term care or disability or health-related needs. So keep that in mind and do some further research on that to see if that'd be a benefit potentially for you. But you can change the beneficiary over time to anyone you have a social security number and a name for, whether or not they know they've been named as a beneficiary. So you could change it from your kid to a grandchild. You could use it for many times a spouse or yourself for continuing education, or someone else that you've named in there. And you can have many of these open. And the money inside will grow tax-free, and you can take it out tax-free for the proper purposes. But you can also bring this back into your estate and only have a penalty on the growth of the assets in the fund, versus with IRAs, many times if you violate, you're paying a penalty on the whole amount that's in there, not just on the amount that's grown. And many people don't know that you could open dozens of these if you wanted to. And it could be another thing to help you manage liability, risk, if you feel like you're a target, or just help you with tax planning and educational planning, et cetera. And many people just overlook 529s as something you just put a tiny bit of money into just for your kids going to college one day, and don't know about all the different ways that this can be used. this was one of the top 5 most interesting tax expert interviews we've done so far. We found someone that's been doing 529 plan work with clients for 23 years, and we did a 20-minute interview with them as part of our 100 tax expert interview series. So I hope that was helpful to hear about. I'd like to open it up for questions now, but while you're thinking about what questions you might have, please submit those through the Zoom software here. I just want to go over a couple more case studies of things that we're working to structure. These are not available for investment right now. Eventually, they may come out on investorclub.com or be shown to our close investors that we've just grown a relationship with, either here in Scottsdale or through the platform. But we're working with a manufacturing company. It's another example. They would qualify for R&D tax credits. Biden is talking about a Made in America tax credit that would help manufacturing companies, but also minority-owned manufacturing companies that are US based. And so they might have future tax credits coming their way. They would qualify now for an R&D tax credit that's beneficial for when you're manufacturing, doing software development in the US. And if your company is less than 3 or 5 years old, you get bonus benefits with the R&D tax credit. But also they buy a lot of equipment. And so they were going to give away 20% of their company. And this is a move that maybe you could make as well at some point, but we essentially went to them and said, well, how about you don't give away 20% of your company? You make this super tax efficient, and you turn it into an income stream for investors. They're not illiquid for a decade, and you give away a lot less, maybe 5% equity, and have all the capital that you need raised. And he leaned forward and said, yeah, that's great. And we're flying down there to look at his manufacturing plant in early March. The other example is a bath salt company. We've closed a couple, 3 rounds of investment with their manufacturing business. Again, an R&D tax credit. They're looking to buy more machinery. And again, that would be something that would be a tax efficient investment vehicle potentially for investors that can come in there. So that's something that we have done and closed deals on. The last one is we acquired a multifamily property last year. We did a cost segregation study on it. And right now we're looking at an office building for a couple of $1 million. And it would be a prime prospect for a cost segregation study. And it's a cash flowing asset. And so it's something that if any of you have a private investor run a business, it's something to consider when you buy an office condo. Once you're done using it, now you're trying to sell your condo to someone who needs that exact same size space, or to an investor, but there's no cash flow for the investor. If you buy a larger office building and you can use cost segregation to make it more tax efficient, and there's 9 people paying you rent and you're going to occupy one of the office suites, now the pool of investors who might want to buy that office building from you one day goes up, because it's not just an owner operator investor, it's just maybe a cash flow investor or someone who wants cash flow plus they're an owner operator. So please submit your questions if you have any. That's what I wanted to get across for today. I know it was a lot of different things. Hopefully it wasn't all super common sense stuff that you already know. How could you work together as a private investor? How much in assets do you need to have? Bill, the best way would be to email me at richard@investorclub.com, or just shoot me a text at 305-333-1155. It also is free to register at investorclub.com. It just takes like 3 minutes, but that'd be the best way to get in touch. But also, if you have any questions about what I said and you don't want to ask in front of everybody, I know some of you are very private. You don't have to be a client for me to be helpful to you. So feel free just to text me, email me, and I'm happy just to be helpful. And hopefully it doesn't take 11 years to do something together if we start talking, like the dental clinic example. But many times we speak to people for 9 months or 2-3 years before anything really meaningful gets done together. That's kind of the name of the game in the space we've found after doing this for about 14 years now. Any other questions about the specific content, about bonus depreciation, cost segregation, HSA accounts, 529 plans, or any tax code niche that you've always been curious about or feel like you're missing the boat on that you could use a connection to? Because we're looking for additional topics. We've only done 52 of the 100 tax expert interviews, and I'm sure we'll get to 75 pretty quickly naturally. But if we don't have an interview on a topic you're curious about, we could go and hunt down an expert and do one if it's something that we agree would be of interest to many investors. I don't see a flood of questions coming in here. I do get a common question. I guess I'll just share this one and then we can just wrap up the webinar a bit early if there's no questions. A lot of investors, when they are looking at their tax planning, say, hey, how can you help me with my business? Or how could you help me with my tax efficiency? And we look back at what they've done the last 3 years, and some mistakes, once they're cooked into the year, there's nothing you can do. Like QBI is an example of that. Sometimes it's transactions that have closed not within the right structures is an example of that. So you want to structure things before you put your money in. You want to get things in writing before you sign on the dotted line and send over that wire transfer. If you have a pending sale of a business, you want to start structuring things now, even if it's 18 months away, 2 years away. And there very likely are ways to be more tax efficient year to year. And there's always another layer deeper you can go and more sophisticated you can go. And once you understand the dynamics of a lot of this, then you can pick and choose things that fit what your strengths are and your risk comfort level, where you're based geographically, what type of cash flow you're looking for. And that's the real power of this comes in, is customizing this to your reality and your timeline of investing and your risk preferences. And I would be very skeptical, and I would run the other way if on any webinar like this or any investment content that you consume, someone says, oh, you for sure should be invested in ATMs or gold, or you for sure should have this in your portfolio, because I don't know you at all. And to make a blanket investment recommendation is just by definition not respectful to you and where you want to go, because it's not customized to your needs. So I'd always be very careful on making sure that tax strategies and investments are really customized to what you're looking for. Can we email you for the cost segregation firm information? Sure. Leslie, feel free to email me. It's just richard@investorclub.com. Even if you're not watching this live, for better or worse, I live in my email inbox every day. So I'm happy to be responsive there and helpful. So if there's not any more questions, I think we're good for today. Unless there's anything else from Camaplan that you'd like me to address to kind of wrap this up, then I think that's it for the content.
All right. Thank you, Richard. Thanks, everybody, for attending. Obviously, if you have any questions, Richard has given you his contact information. Please feel free to reach out to him or myself if you have any questions about self-directed IRAs. And I hope you all have a great rest of your evening.
Thank you. Take care, everyone. Bye.